Hello, good evening, traders. I thought of making a video on some cash covered puts. These are a favorite option play of mine. I was working on compiling some of the numbers for fairly volatile um, optionable securities for the upcoming week, and I thought that I'll make a video to describe my process. If in case it helps someone else. So normally, how I organize the data for analysis is I'll take the instrument that I feel I'll take this stock that I feel has been moving quite a bit. I study the chart, um, and I determine sufficiently large areas of support and resistance. At least like 20% or 15% wide. Having done so, I pick out a favorite strike, which is always an out of the money support level for me. That's normally how I do it. Others do it differently when they sell cash covered puts. For me, once I've identified what the support level is, like for example here for plug, it is the 50, 51, 53 area. What I will do is I will write out what the premiums are for that particular strike price. What's the option premium, and what is the probability of the price dropping below the strike level, right? By end of the week, because I always do weekly covered puts only. So once I have that data for the stocks that I'm interested in, right, what I'll do is I'll do a quick margin outlay calculation, which is nothing but the strike price subtracted by the premium that I received times 100 times the number of contracts. So that's the calculation over here, which should be strike D2 minus the premium collected C2 times 100 times B2 number of contracts, right? So that's the amount of money that I would need to make sure I have available when I sell this cash covered put, because obviously that's how covered puts work, right? If the price drops below my strike, then I'm obligated to purchase the underlying security at my strike price, which is obviously, well, it's not a bad outcome for stocks that I don't mind owning actually in the long run, right? Sticking to the industry, prevailing industry trends, obviously. So all of these stocks have good outlook in the medium term for sure. So I don't mind a capex outlay for the put that I'm selling. Now I obviously also gather up the premium I'm collecting, which is nothing but the premium times 100 times the number of contracts, right? Then I calculate this percentage return annually, which is simply um, how many weeks I'm able to obviously run this strategy, which would be 48 weeks, give or take, for the weekly options. I just multiply that by the return that I'm expecting for what I collected divided by what my outlay was, right? I just kind of collapse that calculation into one little thing over here. And then I do another thing. I will also multiply I will divide rather the annualized return that I'm expecting purely from the option calculations by the probability of the instrument dropping below my strike. These blue uh, uh, the blue text, all of the blue text, the blue numbers are all inputs. Everything that's calculated is just the is black in color. Well, technically they should be blue as well because I'm not calculating the number of weeks available, right? For a weekly option, I have 48 attempts to trade that. Anyway, for monthly, I have only 12. Anyway, so idea being that I would like to not only understand what my annualized return on the option is with this strategy, I also want to find out what is my what is my return over risk, right? The ROR. So I'll take that and I'll divide that by. So the higher the risk I'm taking, right? The higher these numbers. Let's say 0.35 is high, zero point 0.4 is really high as an example. Then based on whatever I'm getting annually, the division of this number by this number should place that particular option right here, the beam option in this case, lower in my list, right? So that's all I'm doing. So I'm trying to like arrive at a return over risk ratio which I will then use the beginning of the week, preferably early in the week, obviously, before the underlying starts to show its hand. I would just basically gauge what the turnover risk is and take potentially 2 to 3 trades in the top 5 or top 6, depending on what's going on and how comfortable I'm feeling. So that's my methodology, guys. I felt like sharing this. It's not a really geeky option play. I'm no option geek. I'm just looking for some basic opportunities to capture some excess alpha, right? Annualized alpha, anyway. And I feel like even though some of the nice larger numbers here, such as the 119, 120 annualized return show up, they are not necessarily better, right, than this little guy over here, simply because of the risk probability I'm dealing with in order to capture that much premium for over a week, right? And also the I don't take the margin outlay as like a factor yet, meaning I'm having to put up $21,000 for this trade, right? For about a near 5 ROR. For this guy, I have a 5.7 OR, near enough, but I have half the margin outlay. I haven't taken that into consideration yet. It's not a big deal for me just yet, but I feel like a pure play ROR calculation is really useful for this kind of a strategy. Now, I'm kind of new to options. I don't do too many. I've done covered calls before. I've done, of course, covered puts, but yeah, I've dabbled a little bit with vertical spreads, and I might actually make a video on a fairly nice vertical spread strategy that I've started to experiment with lately. But this is definitely my go-to options trade. So there you go, guys. Hopefully this helps somebody. I haven't done too many here. I've probably captured 30 potential. I won't call them trades yet, but 30 potential, options. Um, as you can see over here, and I kind of ranked them based on the ROR. Unfortunately, the bad boys, like the pricey Netflix, Amazon, Baba, these guys are all at the bottom of the list. They don't represent too much return over the risk that I'm taking. Anyway, so that's the video, guys. Hopefully you like it. Please like and subscribe, and thanks, obviously, as usual, for coming and watching.